Welcome to the first Mainsail webinar of 2021. It's funny, I'm still having a hard time getting used to saying 2021. I wrote a check the other day, and just like everybody else, I put 2020 and had to tear it up. So we'll get there. Anyway, we're thrilled that all of you would spend some time with us tonight and join us. We're really excited about what we have to share. The format, if you haven't been with us before, is we'll probably spend about 20 or 30 minutes together, and we're going to keep it really short and sweet and compact and informative. Brandon's going to share with you information about the market at large and the economy. I'll come back at the end and talk about some financial planning ideas and tax ideas, things that we're looking at. And it should be a really, really informative session. And we're, again, very, very grateful that you'd spend some of your time with us tonight. For those of you that have not met us before or not been on the webinar before, this face belongs to Adam Laibson, one of the co-founders of Mainsail. And the other face you see there is Brandon Steele, the other co-founder. And I think with that, I will go ahead and give you the floor, Brandon.
That's good. Thank you guys all for being here tonight. It's good to get these going here right out of the gate in a new year. I think there's something that we all have on our minds, and so a really good time hopefully to kind of give our thoughts on what we're looking at ahead and kind of summarize what we've seen in the looking backwards too. I think we all kind of hope 2020 was just kind of like one long bad dream, and right out of the gate it seems that nightmare kind of continued into 2021. Yet here we are, almost a month already into 2021, and the markets just keep on climbing. So we're really excited to kind of share why that's happening and what to expect as we look forward here in the new year. If we look back at 2020, it's just crazy. I mean, we had civil unrest, we had a global pandemic, we had presidential election, and giant killer bees swarming us here in Washington. If you would have told me that we had all these events happening in one year and that the stock market would be up somehow in the double digits, I would have thought you were out of your mind. Yet, here we are, right? Starting the year, we're, stock market's up just a little over double digits through 2020. And, again, it just kind of keeps piling on. So, I think the question is, well, how did that happen? Like, what's going on? Why is the market able to just keep bouncing? Part of it that I want to maybe focus on a little bit is the level of advancement in technology, right? The pandemic was not good, or the pandemic is not good, I should say. However, there are some good things that have come out of it. I mean, the level of advancement in what we're doing as a country, with the vaccines and the medical field, technology, you name it, has been fast forwarded like crazy. I mean, you look at what's gone on, and it's probably fair to say a few years of growth was kind of like shrunk into this 1 year. It wasn't by choice, but we were kind of forced to adapt. I mean, look at us, right? Doing these over Zoom now, whereas normally, it was kind of and we still do the one-on-ones, but you get the idea. With that, a lot of companies have become a lot more productive as well, right? There's a lot of challenges with COVID, don't get me wrong, but a lot of companies have gone into this situation where now they're much more productive than they were just looking, a year back. You pile that on with massive stimulus that we've seen through the course of last year and possibly more to come. You pile that on with low interest rates. You pile that on with a Fed that is, really throwing everything they can at the markets, and you really get this push, this catalyst for growth. Now, as we look forward, obviously the question on everyone's mind is what's going to happen into 2021. The first thing that I want to really spend some time on is the impact of what just kind of came out a couple weeks ago, which is the Senate going to the Democrats now. And so that was quite the shift from where we had originally thought things were going to move here in 2021. Without that, probably a stalemate. There probably wasn't a lot that was going to get done. As you might imagine, there was probably going to be a little bit of contention between the parties and nothing really getting through. Now, that is not the case at all. So it's very likely as we look forward that we see some stimulus come out. In fact, that was one of the big topics of conversation here today. It looks like they're looking at another 1.9 trillion or so is kind of what they're aiming for. And with all that extra money in the economy, the markets can still kind of continue to run with that, additional kind of boost. In addition to that, it's very likely that we see taxes raised at some point. And Adam's going to talk much more to this on the planning side of things. What I want to share is more on the investment side of things. And so what I'm really focused on here for my portion is the corporate tax rates, excuse me. It's very likely that corporate tax rates get raised at some point. Now, even though the markets have done well, the economy is not doing so great. So I do think that it's very likely this gets carried out. However, my opinion is that most likely those rates don't change until possibly 2022 or something along those lines. Basically, I don't expect the tax rates to be raised unless we kind of start poking our head out of this a little bit more, if that makes sense. So with all this, we kind of see another injection here, another boost in the markets. We expect 2021 to be another good year based on what we know now. As we saw last year, that can change in the snap of a finger. So that's what we're seeing as it stands today. Now, if we look a little further out, as you might imagine, all of these programs, all the spending, potentially higher taxes, all this stuff does have some impacts, right? Now, what that is very, very hard to say. When we look 3-4 years out, it's almost impossible to say what's going to happen, because what's important is how these things get unwound or how this is all carried out. So as we think about the Fed kind of backing off on some of their asset purchasing, as we think about tax rates being raised, as we think about interest rates rising, which kind of has already begun to some degree, the levels that those are done and how they're done are going to impact what that means in the future. So right now, when we look at this kind of injection that we're seeing in 2020 and also 2021, I would say that typically may lend to slower growth in the years to come, right? If we kind of borrow from the future, we've got to pay it back at some point. And then also, if we do have some higher taxes in the future, that can slow down business growth and profitability as well. So it's possible we see a little slower growth in the future, but the truth is, it all depends on how this stuff gets carried out. And so it's very difficult to predict too far down the road. As we look into 2021, again, we really see some good opportunities still. And, all the stuff that is going on is kind of that fuel to the fire, so to speak, for the markets right now. With all of this in mind, we talked about this last quarter, if you were on the call then as well. But we've really shifted a little bit. We still have a lot in growth, but shifted a little bit to value companies, which have really started to outperform a little bit. And then recently also looked at increasing slightly the emerging markets sector. And that way, if there is, you may have heard some of this talk about a potential weaker dollar, if tax rates rise, some of those things can benefit not all, but some of the emerging market exposure that we have as well. So those are some of the things that we're kind of looking at. The key is, we see a big opportunity ahead for the U.S. markets, but we also really want to make sure that we're managing risk, right? We don't want to get too far ahead of ourselves. So it's really risk management, but playing quite a bit of offense as we look into 2021. I think I'll turn that over to you from there, Adam.
That was my cue, which I totally missed. Perfect. Thank you very much. So I'm going to talk about two different things for my piece of the town hall tonight. The second part will piggyback on what Brandon was describing, but I thought it would be appropriate to start off with just a kind of a refresher on contribution limits, what's changed, what hasn't changed for 2021. Excuse me, it seems like a good idea to mention this here the second week of January so that we can all be on the same page going forward. So to make it relatively simple, actually, and unfortunately, there wasn't a whole lot that's changed for 2021. So when I talk about contributions, as it stands right now for 401ks, 403bs, 457s, the TSP plan for those of you that work for the government, your contribution limit is still $19,500. That has not changed. If you are 50 and older, there is still the $6,500 catch-up provision. So that can give you a grand total of $26,000 of your own money that you can put away outside of whatever your employer might match. As far as IRAs go, Roth IRAs, traditional IRAs, unfortunately, the contribution limit was not changed for 2021. It's still $6,000, plus another $1,000 if you're 50 and up, so you can put in a little bit more. And if you participate in a simple plan, a simple program, that limit is $13,500. So that's something to keep in mind too. I think one thing I'll mention, which is pretty important, is that for those of you that were on the call last quarter or just know this from your own experience, back in March when COVID was sort of hitting its stride, unfortunately, the CARES Act removed the RMD requirement last year for traditional IRAs, 401ks, beneficiary IRAs, that sort of thing. Any account where an RMD was required. Well, unfortunately, that was not renewed in this most recent piece of legislation that was passed. And so RMDs are back, which means that we want to be mindful of that going into the year here and watching how market performance can affect the timing and the structure of how we take those RMDs out. As a quick reminder on the RMDs, which stands for Required Minimum Distribution. So right now the age is 72. So if you have not started taking RMDs, 72 is when they begin. If you were already taking RMDs or you would have last year, they continue for you. But just as a reminder on how that's calculated, RMDs are based on the account balance as of December 31st of the year prior, right? So let me kind of talk you through an example and explain how those are calculated. If, for example, at December 31st of 2020, you had an account, let's say a traditional IRA that had a value of $100,000. The IRS publishes a table, a distribution timeframe table that will indicate to you what percent, or not percentage, but what multiplier to use to calculate your RMD. So if you're 74 years old, that multiplier is 23.8. And so with a little bit of quick math, your RMD for this particular year for 2021 would be about $4,200. Okay. If you're looking for that chart, if you want to see what that actual worksheet looks like, if you do a Google search for IRS RMD, one of the first things you're going to find is a PDF file from the IRS that has that worksheet that explains how to calculate that. So the long and the short of it is that RMDs are back, and we want to make sure that we don't skip over that because there's a pretty hefty penalty if we do. Also, to make the math simple, I know for all of our statements and for virtually every custodian that has an IRA platform, you will see a box on your statement that says 2021 RMDs remaining. So you can get a better sense of whether you've taken the RMD out, whether you're on track, if you're doing it in a systematic way, or whether it's now December 15th and you realize, uh-oh, I should have done it sooner. All right. So I hope that makes sense. And that's kind of, I just wanted to talk about that in a high level. If there's more questions, let us know, but just to give you a sense of what those contributions look like and how RMD is calculated. But the thing I want to talk about, I think, to compound a little bit more on what Brandon was describing is that before the election, back in November, one of the things that was discussed quite a bit would be, well, what if we have an entirely blue Congress and a blue White House? What happens then? Is there a possibility that our taxes are going to go up? What's going to change? Are they going to push through tax changes like on day one? And so here we are, as Brandon mentioned, we have a blue Congress and a blue White House. And I think the idea that taxes will go up is very likely. It's probably something that's going to happen in the next, as Brandon mentioned, maybe the next 2 years, year and a half, 2 years. But what we're getting an indication on is that it is not something that's going to be a day one project. So there was a lot of concern that, oh my gosh, they're going to push through tax reform and the market's going to drop and it's going to be the end of financial times as we know it. That is not how things are bearing out right now, but it is inevitable that there will be some tax changes. And so with that, we've been getting a lot of questions about, I've heard this and I read a report on that. And is this really true? And can they actually do that? And so what I thought I would talk about are the top, let's say 5.5 things that we get asked about a lot. And I want to kind of talk that through so that we have a sense of what's going on. And if we need to make some planning changes, we can do that. But again, I want to stress that it seems like at the moment, the government has bigger fish to fry than raising taxes. So This is not something that we have to worry about like next week. The first two things I want to talk about actually fit together, so I'm going to kind of link them up. One of the things that came up as a possibility is that the top tax bracket would be bumped back from 37%, which is what it is right now, up to 39.6%. So I want to also mention the fact that this is only on the highest sort of income bracket, which if you're single is about 523,000 for this year. And if you're married, it's a little over 628,000. So if you're in that category, that's a possibility. Okay. Now, here's why this is important. I want to carry it over to the second thing. There's discussion, and part of the plan may include some changes on how capital gains and dividends are taxed. So if you buy a stock for $50 and you sell it for $100, the $50 you've earned is considered a realized gain. And that gain is going, if it's in a non-qualified, non-retirement account, it's going to be taxed in some way, shape, or form. Okay. If it's a short-term gain, it'll be taxed like ordinary income. That's not changing. But if it's a long-term gain, the way the tax laws read now is that no matter if you're in the highest tax bracket, that long-term capital gain top bracket is 20%. So even if you were in the 39.6 or 37% bracket, the most you would pay on that $50 of long-term gain would be 20%. So what's being sort of discussed is raising that to that highest tax bracket level. Now that would only occur if your income was over $1 million. Okay, I want to stress that. So for those high income earners that don't pay a lot in the long-term gains, they pay the 20%. This can be a component of some tax planning, because now if they sell or if they're receiving capital gains or dividend income, it's going to be taxed at a much higher rate. All right, so those two things together are really important. And again, they may be coming down the road, but not something that's going to happen like next week. One thing that is important, though, and this would affect almost everybody, is the possibility of eliminating the step up in basis. And I want to explain what that means. So back to my example, if I buy a stock at $50 and sell it at $100, my basis, what I put into it, essentially, my principal, is the $50. Okay. So if I have that example, let's say that I buy a stock at 50 and I hold on to it. Okay. And so years go by, 5 years, 10 years, 20 years go by, and it's gone from 50 to $100. If I sell it, like we already talked about, there's going to be a long-term gain that's paid. If I don't sell it and I pass away, and that account or that particular stock position goes to a beneficiary, there's something called a step up, which means that as they take over ownership, their basis is no longer the 50 that I paid, it's the $100, it's the market value at that time. Okay, that's the step up. And so from an estate planning standpoint, if you pass on stock to kids or grandkids or whoever the beneficiary might be, that's one of the components that goes into estate planning. Now, what they're kicking around is the idea of taking that away, of stopping that step up in basis, which would mean that I no longer have an incentive to wait, right? Because if I bought it at 50 and I've been waiting and waiting, and I'm not going to sell it because I want to pass it on and give it to my kids at that stepped up basis amount, and that's no longer a component, right? Now there's necessarily no incentive for me to wait. And if they inherit it, they're going to have the same issue that I had. They inherit my basis. Okay. So that's something we want to keep track of, because that would affect everybody that has investments in stock and non-qualified accounts. So that one we'll watch very closely. Again, not happening next week, but it's definitely on the horizon we want to pay attention to. Another thing too that's been talked about that could affect some people is Social Security tax. So as most of you probably know, right now the Social Security tax is 12.4%, and that's usually split between the employee and the employer. So as you're working, you probably see on your paychecks that there is some amount of tax going to Social Security, but there's a limit to that. And that limit is 137,000-ish. Wait a second, is that right? Let me check my notes here. Yes, about 137,000. So after that amount of income, that's where the Social Security split stops and you don't pay any more. But what's being looked at and explored is resuming that at the $400,000 and up income level. Okay, so you may have heard one of the campaign pieces that Biden talked about was no one under 400,000 is paying any more in tax. Well, here's a new tax that happens for the $400,000 and up earner. So if you make over $400,000, what would happen is that you'd pay Social Security tax up to the wage base of about 137, then nothing until you hit 400,000. All of your earnings over 400,000 would be back on the same schedule again, right? You'd split that with your employer, that 12.6%. So that can be an issue from a cash flow and a take-home pay standpoint for those, high income earners that this might affect. So that's something else. The other thing I want to mention too is that there's not all bad that can come from a new tax package. There's a couple good things that are out there as well. One of them is reestablishing that first-time home buyer credit of $15,000. So that could be a positive for first-time home buyers. There's talk of tax credits too, which is really a great thing for people who take care of the elderly, whether it's at home or in a different level or a facility. So there can be some positives and some tax credits that might help people as well. So where I'm going with all this, and I know that I'm speeding through this to try to explain how some of these things work, is that there is still a lot that's out there that could potentially affect everybody to some degree when it comes to taxes and financial planning. As I mentioned before, there are other things they're working on first. It seems like getting COVID knocked out, as Brandon mentioned before, some fiscal stimulus to help the economy, get back on the right track again. Could be infrastructure, jobs, that sort of thing. But taxes are not something that's off the table. So that will come back into the conversation soon. And so as we know more and we realize the likelihood and certainty of some of these changes, of course, we're going to talk to you about it. We're going to share ideas with you. We're going to try to get ahead of it and be as proactive as possible. So just, again, wanted to let you know what some of those things are, just mention them at a very high level. If there's more questions, let us know. Of course, we'll talk about it and see if we need to do anything at the moment. But that is essentially what I wanted to kind of, share with you from a very high level. There's a lot more to it. There's a lot more things that are being considered, but those are the ones that we get questions about quite a bit. One thing I do want to come back to, I realize that I might not have been clear about this. On the RMDs for 2021 for every year, when you run that calculation off the worksheet, that gives you an annual amount. Okay. So in my example before, when I was mentioning on $100,000 at 74 years old, the RMD was about 4,200. That is for the year. The IRS, could not care less how you do it. You could do it all in one shot. You could do it over 12 months. You could do it, over a little bit every quarter. It's entirely up to you. All they care about is the aggregate total for the entire year. Okay. Very good. So I think with that said, Brandon, I'm going to turn it back over to you for any last thoughts you might have here before we wrap things up.
I don't have a whole lot. Just that, there's obviously potentially a lot of change on the horizon, and it's a little early to Adam's point, to get too far into it. But certainly as we know a little bit more and as we start getting a sense of what that looks like, that'll be a big part of the conversation. And if there is any any things that may impact you specifically, that may be worth exploring ahead of time, we're happy to answer any questions on that or make sure to reach out to you as well on that directly. So.
Perfect. Okay. Well, I think on that note, we will call it quits here on the first Mainsail webinar for the calendar year 2021. We'll see everybody in a few months again on the next webinar, and I'm sure we'll talk to a lot of you, if not all of you, in the short term. But we want to wish you a very happy new year, a very healthy and prosperous one. And we're here every step of the way for any challenge that might come up. And we look forward to talking to you all very soon. Thank you and good night.